Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, certified financial planner practitioner, and I'm going to be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you an idea of what we've got in store for today's show. First off, we're going to be talking about median 401k balances. It's always nice to have benchmarks, like how much money am I supposed to have in my 401k? We're going to talk about some benchmarks where averages sit for different age ranges. So maybe you can compare yourself to those savings rates and see if you're on track or behind or ahead or whatever it is. So that's going to be the first thing. In our second segment, we've got our real estate pro, Chad Kritzis with HomeSmart Real Estate. We're going to be talking about a little bit different. We're oftentimes talking about buying and selling residential property. We're going to be talking about leasing, not just residential, but potentially commercial. But if you're thinking about being a landlord, that's the segment you're going to want to see. In our third segment, tax season's over, so everybody's paid the state and paid Uncle Sam, and WalletHub is out with their annual list of the most and least friendly tax states. And some of the results might surprise you, so we're going to talk about the best and the worst on that list. And then we have a viewer question at the end of the show we're going to get to as well. So lots to talk about. Let's jump right into it. First off, median 401k balances by age. So Fidelity Investments comes out with a lot of information with respect to their 401k plans. Fidelity has 16.2 million 401k accounts and is the world's largest 401k record keeper. So they have a lot of data, and the data they have can be valuable when we're talking about retirement savings plans and looking at some of the numbers that they provide. One of the interesting notes, there were a record number of 401k millionaires in 2018, but you have to remember 401k millionaires are the exception. Given the caps on how much you can actually contribute to a 401k and other qualified retirement plans, it could take you over 20 years to build up $1 million or more in your 401k plan, and that is with double-digit investment returns. So getting $1 million balance is a significant accomplishment. It's not something you should necessarily benchmark your 401k against. The other important thing is it really depends on your age, right? If you're in your 20s, you're just starting out with your first job and your first 401k, nobody expects you to have $300,000 stuffed in there. Meanwhile, if you're 55, 60, your retirement is looming, you're going to expect to have a lot more money. So one of the interesting things to look at is typical 401k balances at various age ranges, and Fidelity provides us with that information. Now, we could look at the average balance, but the average balance would be skewed by the highs and the lows, those millionaires and those people with very little money in their 401ks. It's often more helpful to look at the median balance, and the median is really the middle number. So we're going to look at the middle number for several different age ranges. You can compare yourself, and it doesn't mean that you're on track or not on track. If you're not hitting these numbers, you're way ahead because everybody's situation is specific, but it's a benchmark and it's worth taking a look at because comparisons can often be helpful in this business. So let's throw up the slide and we're going to talk about these numbers really quick. All right, if you're 20 to 29 years old, you're probably in your first or maybe second job at this point. Fidelity's median 401k balance for that age range, $4,000. Now you go up to the next age range, 30 to 39 years old, and the balance goes up by 4 times, $16,500. We go to the 40 to 49-year-old age range, an age range I'm sadly just about to drop out of, and the median balance is $36,900. Next age range, 50 to 59 years old. This is really where you should be bulking up on the funds, $62,700. So it goes up steadily, and there's a significant drop from significant increase from the 40 to 49 age range to 50 to 59. Then we look at balances for 60 to 69-year-olds, and the balance is only $63,000. So major accumulation years in those 40s and 50s, which is exactly what we would expect. So if you're not hitting your number, some things to consider. One of the things that's super easy to do is if you're contributing to a 401k, make an effort to increase your contribution every year. It doesn't have to be by a lot of money. And companies like Fidelity and other record keepers make it super easy to go online, change your figures so that you can bump up the contribution by even $25 or $50 paycheck. So work on getting more money in that retirement plan. All right, up next we're going to be talking about leasing real estate, so stay with us, there's more to come. Welcome back to the Money Pros. I'm with our real estate pro now, Chad Kritzis with HomeSmart Realty. Chad, welcome back to the show. Good to see you. So We're going to be talking about leasing real estate, which is not something we talk about typically on the show, but I think it's a great topic. Before we leap into that, though, we always want to get a market update from you. And I have to say, if my anecdotal observations about what's going on in my town are any indication, the real estate market is on fire in the first quarter. Am I right or am I wrong?
Well, the town you live in is super hot at the moment. There's no question about that.
Everything's for sale and everything's getting bought. Stuff is going like this.
It's selling like crazy.
Yeah.
They actually last night they released the updated stats. So we're just going through. We are seeing the beginning of the shift that we've been talking about a little bit. The inventory is up to an extra month's supply. So basically, the inventory over this time last year is up 10%. The number of sales is up 2%, and the median price is leveled out. Okay. So we're starting to see the beginning of the shift. Now, we're not having the financing issues we had a decade ago, so we're not going to see the plummeting that we saw then. Condo inventory, once again, up 12%, sales down 12%, and the median price is up 13%. And still the hottest market that we've been talking about the last few months is the multifamily market. Inventory down 1%, number of sales is level, and the median price is up 13%. So that multifamily market, especially in big rental towns, has really been on fire.
So, not to dwell on this, but where I live, it's Barrington, by the way. I'm not trying to keep it a secret, but is that town unique in some way, or with respect to how hot the market is, or is it reflective of what's going on in the rest of the state?
Excuse me. Barrington has been very hot. Barrington, a few niche towns. Excuse me. Newport's been very busy. Barrington's been on fire, and Bristol's been very good as well.
All right, well, I'm not selling my house, so I guess it doesn't matter much for me, but that's interesting.
I know a guy.
I got to live somewhere, though. Yeah. That's my whole problem with that thing. Anyway, let's talk about what you alluded to just a minute ago, which is 3 families, and that is part of what we're ultimately talking about here by leasing property. Generally, if you're going to become a landlord, is what we're talking about here, and rent out property, there's 2 types. There's commercial and residential. Can you just start with kind of a little bit of a primer on the pros and cons of each of those and what people have to keep in mind?
Right, well, they're 2 completely different markets.
Sure.
Right? So if you own a business, so you need to go rent a commercial space, you need somewhere to move your office. Now, there's different types of things like triple net. So do you pay the taxes, the insurance, who's responsible? And the same thing with residential, who's responsible for the plowing, the landscaping. Like we have a new office now, and the grass needs to be cut, so we had to go through our lease today and figure out who's cutting the grass or who's paying to cut the grass. So commercial and residential there's so many different types of categories and so many different types of tenants. Obviously, is where you're going to live or as a residential landlord is a different animal as well.
And particularly on the commercial side, and we're not really going to dwell on this so much, but the range of properties goes from little tiny storefronts up to, there are towers in Providence for sale for millions of dollars, right? So we're just talking commercial real estate. It's really a very specialized animal, even segmented among different types of commercial real estate that people deal with.
Absolutely. We opened a new office a few months ago, like we discussed, and same thing. When you all look at offices, it's what town are you going to be in, the size of the space, the cost per square foot. There's a lot of different variables, especially with commercial real estate, and a lot of it's based on location.
So I think the appeal, let's talk about the residential real estate, for a lot of people is, everybody lives somewhere, so they've got a residence. Good chance they've rented before, so they've had the experience of signing a lease as a renter. Now maybe they own a property or they're looking at their first property. It seems a little more attainable for a lot of people. Not to say you can't get into the commercial game either, but for many people, residential seems more attainable.
Well, you need a specific need for a commercial rental, right? It's not something, but you always need a place to live.
Right.
So residential is much more common.
Do you have a lot of clients that, first-time home buyers are a big segment of the market.
Huge segment, yeah.
The American dream, right? Do you have a lot of people that consider some type of multifamily unit when they're looking at their first home where they're going to be owner-occupied, maybe live in one unit and rent out one or more others?
Absolutely. And a lot of it has to do probably with the status of, you have a couple of kids, right?
I got 4.
Four, right? So more than a couple, right? So
a couple twice,
right? Exactly. So you're less likely of a buyer that's going to go buy a 3-family house and move your 4 kids into the first floor and have other people living in the property with you. When I was a younger guy, and that's exactly what we did. We buy multifamily, you live in one, it helps defer the cost.
And I would point out, like, I didn't always have 4 kids, but when my wife and I first got married, our first house, in fact, was a multifamily. We bought a 3-family as a traditional sort of format around the Northeast here, and lived in the first floor and rented out the other 2 floors. And I will say, and this is not just about my experience, I don't want to get bogged down, but while I lived there, it was actually a great experience. If it's owner occupied and you can take care of it and keep an eye on your tenants, for me it was fantastic.
It also changes the financing if you're living there.
Well, and that's a good point too.
Right.
As soon as I became an absentee landlord, it didn't work out quite as well. But there were some situations unique to my circumstance, so I don't want that to dissuade anyone. But one of the really good things about it, and this leads me to my next question, is it did allow me for a period of time when we had to move, and I had to move for my job, to buy another house, in this case a single family, and I kept my multifamily.
Right.
Is that something you see people aspiring to do, the idea that, you know, I'm going to buy this house, I'm going to live here, stock up some money, I'm going to buy another one and keep it, and they aspire to having a real estate portfolio, so to speak? Is that an objective, and does that make sense for people?
It does. Well, it matters in your financial situation. I mean, you're a financial planner, right? So a lot of the time you hear diversify, right? So you have your 401k that you've been discussing, you have a couple of multifamilies. We have a guy that works with us in our office, and he's been buying a bunch of 3 families in the last couple of months and kind of just fixing them up and renting them out and just keeping them portfolio. I mean, at the rate real estate goes up, and much like the stock market, historically, if you took a very easy scale, real estate goes up 3% a year forever, right? There's some ups and downs and highs and lows, but real estate's a great investment. And if you have a 3-family or a 4-family or even a 2-family that can cover itself in the rents, it's a great investment.
And I'm absolutely an advocate for this. I have a lot of clients that ask me if it's a good idea. One of the things that I try to bring up with them is that, unlike a stock or bond portfolio that doesn't require a lot of labor, being a landlord is work. So can you talk about that a little bit? It's a little bit of a part-time job, right? You're not just signing up to be an owner, you're signing up for a job. Self-employed, essentially.
I guess, right. So, but the question, let me ask you, I'm just not a handy individual, right? So if something happens at my house, I need to call someone, one of my rentals, I'm a landlord as well, I need to call somebody to go over there and help out with that scenario. So there's a cost that comes into it as well. Then you also have, you start getting deferred maintenance issues, right? Because like you said, you moved out. Once you move out of the house and they start getting some water in their basement, sometimes they're not calling you. I had that happen twice. Yep. Where they start getting all this water and they're not calling you. Then all of a sudden you go over to check out the house because you haven't seen it in a year, and they're all the flooring in the basement's mildew and mold and torn up.
And you run into the same problems that any homeowner runs into, where sometimes it's hard to find good help, right? So you could live in a single family and need an electrician and struggle to find somebody that's going to come out and do your little job. You have those same problems potentially as a landlord. So I think it's an important thing to keep in mind. Now, residential rentals come in a couple of different flavors. It's not just year-round, like I've got a 3-family and families live in the second and third floor. There's other ways to go. What am I talking about here?
Well, there's a few different scenarios. So you have really seasonal rentals, summer, winter. In winter, a lot of times students, right? Because I'm not going to say they're not always the best tenants, but they're going to be there for the 9 months that you don't do summer. They're consistent. Right. Let's go with consistent on this show. But the summer rentals, now obviously that's dependent on the location. Bristol, Newport, Narragansett, huge summer rental markets. And then you have different types, you have weekly, monthly, seasonally. Now you got to be careful, and this is one thing a lot of people don't realize, like a city like Newport, for instance, unless you're in a very specific general business area, you can only do monthly rentals. You can't do weeklies. And they actually hired a consulting firm out of California to catch all the people that were doing them. So unless you're in a very specific area, you can't do weekly rentals in certain areas.
I guess because they perceive it as being competition for more traditional lodging, hotels,
bed and breakfast,
things like that, bed and breakfast. So that brings up some interesting questions. You talk about being familiar with the regulations in your area.
Absolutely.
Obviously, that's going to be an important thing. But some people, particularly with the shorter term rentals, aren't familiar with some of the taxes that are involved. Right. And you were going to fill us in on some of that information here in Rhode Island.
Rhode Island instituted an 8% sales tax, so 7% sales tax, 1% hotel tax.
Hotel tax, right.
Right, so anything less than 31 consecutive days. So if you're in Middletown, let's say, and you're doing weekly rentals, you have to now pay a tax. And 8% is pretty significant, right? So if you're using an agent or a renting company, now you got to pay them. Then you got to pay an 8% tax on top of it. But I mean, there's rentals, by the week in these places that are $1,500, and there's ones that are $25,000 for the week. So you have a whole different scale. So that tax burden could be substantial.
Now, I was talking about, right before we started taping the show, a recent experience I had with Airbnb, which is a website I'm sure you're familiar with. I know you've used it as well. And I've also used websites like VRBO and HomeAway and things like that. Do you see those websites shifting the vacation rental real estate market? Is it becoming more attractive for people to buy houses with the idea that, hey, I'm going to live there for the month of September, but I'm going to Airbnb it for the rest of the year? And is that catching on? Because it seems like Airbnb in particular is really taking over the lodging industry in a lot of ways.
It is, but a lot of those are short term, right? So if you, like you just said, you used an Airbnb house, but used it for 2 nights. So we're not going to have a lot of involvement. I mean, generally speaking, we're not going to have a lot of involvement in a 2-night rental, right? We might do a week, or more often we do a month or a season. The summer, in Portsmouth, for instance, Raytheon just brought in a bunch of jobs. The War College has a huge class coming in August. So those are all factors that affect it. Airbnb may be a shorter term if it's a weekly. Yeah, I mean, is it probably taken a little bit away from some of the work we do? Of course, but that's fine. It's the nature of the animal. But a lot of those sites are based more on the shorter term, which is...
Well, and I'm not even talking about it so much as competition, as more so like, hey, I'd like a house in Narragansett, but I never perceived it as a place that I could have as a second home. But all of a sudden, when an Airbnb comes along and opens up the opportunity for me to rent it out easily and quickly, now I come to you and say, hey, I'm going to buy that house in Narragansett because I think I can pull that off. Do you see that mentality?
You do. You see it a lot because the numbers are so high. Right. The rental numbers for, if you factor what a mortgage is a month and what you're getting, comparatively speaking, per night or per week, I mean, it actually makes a lot of money.
It's a brave new world. I mean, it's changing quick. It's a fascinating industry. Thank you very much.
Thank you, as always.
As usual, we didn't get to all the questions, but anyway, up next, we're going to be talking about most and least friendly tax states. Stay tuned. We'll tell you where Rhode Island lands. We'll be right back. Welcome back to the Money Pros. WalletHub, which is a website we've talked about from time to time on the show, is out with their annual list of the most and least friendly tax states. And I actually think this WalletHub website does a pretty good job of analyzing and providing the data, but behind their rankings, which is something that you don't get with a lot of rankings. And taxes are a big conversation on this show, and with us just getting done with tax season, you're probably all kind of sensitive to that right now. So I wanted to take a look at the rankings. So it's important before we get into the rankings to talk about how WalletHub actually does this. And they break down taxes by state into a few different categories. So they're looking at real estate property taxes, car tax, state income tax, and then sales taxes. So it's also important to point out that in that, they're not looking at estate taxes. So if that is a relevant tax to you, this particular ranking is not going to be that relevant. The other thing that's important to keep in mind is they rank these things equally, but people, individuals are not impacted equally by these various taxes. If you're a renter, then property taxes are not going to be as much of a deal. If you don't own a car taxes are going to be irrelevant to you. If you have very little income, you're retired perhaps, the income tax isn't going to be an issue. So you have to look at those things and consider that this ranking is not necessarily reflective of your life in your state, but it is a good glimpse into how the states compare to each other on an overall basis. So first of all, let's talk about the most friendly. So we're going to break down the top 5, and we're going to run through it. And many of these states, starting with number 5, Nevada, are no income tax states. So clearly that provides a big advantage. But at number 5 is Nevada, and number 4 is Wyoming. Number 3, Montana. So you're going to want to be out west here. Number 2, back on the East Coast, Delaware. And finally, number 1, back out west, way west, Alaska. So those are the most friendly tax states based on those categories that I just talked about. So various states either don't have a state income tax, very low sales taxes, in the case of Alaska, for example. So a variety of different factors that make them. But you'll notice no Northeast states in that top 5 list, which is not entirely surprising, even though New Hampshire doesn't actually have a state income tax. They have some very high property and sales taxes, so that's something to keep in mind. Now let's talk about the least friendly, all right? Throw this up on. Number 47, Nebraska. Number 48, New York. Number 49, Pennsylvania. Number 50, our neighbors to the west, Connecticut. And number 51, because this survey also includes Washington, D.C., is Illinois. Now, we've got some Northeast states in here, New York, Connecticut in particular, not doing too well. But notably missing, Massachusetts and Rhode Island. We can take some relief from that. Let's tell you where they landed. Rhode Island came in actually at number 44 on the list, so pretty far down at the bottom. Massachusetts, We used to call them Taxachusetts, came in at number 26, so that's pretty good. One of the things you want to keep in mind, though, about Rhode Island as you dig into the numbers that WalletHub provides is that Rhode Island actually did pretty well for income tax ranking and sales tax ranking. They were above number 20. For both of those categories, income taxes and sales taxes. Where they really get hurt, where we really get hurt if we're Rhode Island residents, is in our high property taxes and, of course, our very high car taxes. So you have to keep that in mind depending on what your tax situation is. But some recent changes to the tax law have made Rhode Island a more attractive place from an income tax standpoint than it has been in a long time. If you don't know what I'm talking about, maybe we'll talk about it in another show where you should dig into it. All right, that's up for segment number 3. We've got a viewer question coming up. We'll be right back here on the Money Pros. Welcome back to the Money Pros viewer question time, and I love this question, so let me throw it up on the screen and we'll get right to it. Viewer asks, my wife and I disagree on whether or not we need a financial planner. I think we're managing just fine, but she thinks we should work with a professional. How do we know if we need someone to help us? This is a great question. I get it all the time, and the reality is not everybody needs a financial planner. As much as I'd love everybody to run out and hire a qualified financial planner, the real reality is not everybody needs that person. But the thing that strikes me about this question is when you have two spouses and one of them thinks they don't need a financial planner and the other thinks they do, one of the reasons the person that thinks they need one might need one is because they feel disconnected from the finances. One of the great things about a financial planner, and this is if you're an individual or a couple, is a good financial planner is going to help connect you to your finances, help make sure that you understand exactly what's going on with your investments, your estate planning, your taxes, and how all those things are integrated. So if one spouse is asking for it and the other isn't, maybe the one that isn't asking for it is pretty clued in, but the one that is asking for it feels like something's missing. So consider that in your equation when you're deciding whether to hire a financial planner. Other than that, it has a lot to do with how much is at stake, how worried you are about it, and whether you want a backstop and a partner in your personal finances. So it's a very short answer to a very detailed question. That's it for today's show. Thanks for watching. We'll see you again next Sunday right here on the Money Pros. Take care, folks.